Hi, everybody. My name is Lindsay Neal. I work with Chris over at Vice Capital Markets. Just want to say a quick thank you to you all for attending today's webinar on Hedging 101. Before Chris gets things started, we're going to actually let Michelle from lovely MBA of Florida just offer a few words to you guys. So, Michelle, take it away.
Yeah, thanks, Lindsay. I really appreciate it. Appreciate all the participants joining today. I'm going to be very educational. Chris is a very entertaining speaker, so I think you're going to not only learn something, but also be entertained along the way. So again, we want to thank Chris for hosting today's session and Vice Capital. Want to thank them too for being an MBA sponsor. They're an annual sponsor and a member of our association. And I just want to take a minute to, again, thank you for that, Chris, and also encourage anybody who's on the listening today. If you're not a member, there's a lot of benefits. Obviously, Chris and Vice Capital see the value of being a member of the association. For one thing, there's educational webinars such as this. The other thing, we've kind of got three key things that we focus on as an organization, and that is education, networking, and also advocacy. And advocacy is extremely important. We feed into the MBA, National MBA, and if it hadn't been for our efforts, the FHFA would not have reversed their recent decision on limiting non-owner occupied and second homes. So, it's just very important to participate in the association. So if you're not a member, I would welcome you to reach out to me. I'd be happy to go into more detail. But with that, I'm going to turn it over to Chris for some entertaining education.
Thanks so much, Michelle. I really appreciate it. I want to make sure that they're showing me on the main front page here. So yeah, really, Michelle, Gina, Brenda, MBA of Florida, really appreciate the opportunity to be on here. Really enjoyed going to the Combination Conference that was held in June. Got to see a lot of great people that I didn't get to see in quite some time. So really appreciate that a lot. Looking through the list of everybody who's signed up for it, really appreciate everyone being on here. A huge variety of folks from all sorts of aspects of the business on the correspondent side and underwriting, processing, originators, branch managers, some other folks from other hedge advisory firms. There's a huge range. So really appreciate everybody joining. This one here, and very intentionally, a couple different things. One, I don't have any visual aids, and it's intentional. I really want this to feel a lot more like you and I sitting across the table having a coffee or maybe having a nice sparkly beverage if it's after 4 p.m. And less so of a presentation. It's not really a canned presentation I have. It's just some notes. We're going to talk about the what, the who, the why, and the how of hedging. And again, this is Hedging 101. So if you have no background at all in really even sometimes possibly how secondary marketing works, let alone hedging, this is actually for you. If you've got 30 years of capital market experience, that's awesome. I don't know if you're going to really get anything out of this one. I also can do hedging 201, 301, 401, and PhD hedging. So we can maybe make that a different session that we can have. So anyway, what is hedging? Not just what is it for mortgage-backed securities and for mortgage banking, but what is hedging, period? I don't want to use sort of the dictionary definition of it because it's kind of convoluted, but hedging is making a transaction or making a trade to offset risk you have of adverse price movement in something else that you have. That sounded really kind of convoluted, and honestly, that's actually a simpler definition that you can find at Wikipedia. Here's a couple examples. You're a corn farmer, and you know that the price of corn right now is $5 a bushel, and if that's the price of corn, you're happy to plant all these fields, you've worked it all out, your cost is about $4 a bushel to make it, you'll make $1 a bushel profit. You're really happy with that. But what happens if come the end of the harvest season, corn isn't $5 a bushel, it's $3. Now you planted all that corn, you did all that work, and you actually lost money. So a farmer in this case will go ahead and sell corn futures to hedge against the risk that the price of corn will decrease. Same thing could happen in oil. Let's say that you're an oil company, or even you're a smaller oil company. It doesn't have to be somebody big like an ExxonMobil, and you've got a field that you want to develop, and you know that, hey, as long as the price of oil is $55 a barrel or higher, this is a profitable field for me to pump oil out of and go ahead and process. Price of oil is $65 a barrel. This works for me. Again, the risk is by the time you actually invest in getting this out, getting the oil out of the ground and processing it, if the price of oil is decreased, now your profitable venture has become an unprofitable venture. So again, you now sell oil futures so that if the price of oil goes up to $100 a barrel, you're not actually going to be able to reap any of that benefit. But if the price goes below your cost, now you'll be able to reap the benefit and still be able to actually have a profitable production. Yen, same thing. You're selling something where you're being paid in yen, but you only care about dollars. You can hedge that currency risk of receiving a different currency by trading in those markets. It's the same thing that happens in mortgages. Even on a retail basis, when we take a look at what are you doing as a bank, as a mortgage company, as a credit union, you're putting out a rate sheet, you're pricing loans, you're using a pricing engine, maybe it's your own internal, whatever it is. In the end, you can almost think of it from a secondary marketing perspective as though you're agreeing to buy mortgages from your borrowers. When Mr. and Mrs. Jones are making their loan application, at some point, they're going to get to the point where they say, what's my rate today? When am I going to close and what's my rate going to be? Sometimes you're in competition with 7 other lenders. Sometimes you've got a really good relationship and they know that you'll take good care of them. But what drives all of this risk in mortgage banking is the lock. Nobody wants to wait until closing to find out what their rate's going to be. They're going to go through this process with you as a lender. They need to know what kind of terms are going to be offered and how long will you offer those terms for. So the lock is what drives all the risk in mortgage banking of whether, again, you're a bank, whether it's retail versus wholesale, if you're an IMB, if you're a credit union, what drives all of this is that you've made a pledge to Mr. and Mrs. Jones of, I can get you 3.25% for 0 points, and here's your $500 closing cost credit, whatever those terms are. You know that as a lender, I can sell that today for 103. That pays for my costs. I'm happy. So the big risk we have, of course, is what happens if by the time Mr. and Mrs. Jones close their loan, and unless you're a bank or a credit union, you're going to put it in portfolio, we need to sell this mortgage. What can I sell it for? If I thought I was going to get 103, and now lo and behold, interest rates go up, so the price of mortgages goes down, and you're only getting for 101, now I just went from making, say, a quarter point or a half point of a net profit to losing 150, losing 175 basis points. When that happens, someone's probably fired. So how do you offset that risk? One of the ways you can do it, especially if you're a smaller lender, is of course you just counterlock that with an investor, with an end buyer. You get pricing that comes in from investors or from Fannie Mae or Freddie Mac, for example. They also buy loans on a best efforts basis. And you know that I can price it to this, I'm going to counterlock it here, and that's how I mitigated that risk. But it doesn't mean that's perfect. You could still have things happen. You might have something locked with an investor and the terms change. Let's say the borrower needs more time, you need an extension. They go from a FHA loan to a conventional loan. Other things can happen there. Maybe you deliver the loan to this investor you're going to sell it to, and lo and behold, 2 weeks later, they don't like something about it, and they say, no, sorry, we're not going to buy this, and they send it back to you. Well, as the lender, you may have had this nice best efforts lock where you were going to sell this loan at a price of 103. Lo and behold, they kick it back to you, and now prices are 101. So there's some risk that it's very difficult, even while locking best efforts, to completely get rid of, but that's considered a very acceptable way to lay off that risk. Another way, and a way that, of course, is the topic of the conversation for today, is to hedge. And we'll talk about later on in this program, I guess you could say, who hedges, why do they hedge, and how do they hedge? But that's going to be the primary driver here is, as a company, how do we manage the interest rate risk we have? Because we've made a promise to Mr. and Mrs. Jones, and we don't know in the end what we'll be able to sell that mortgage for to regenerate the money and continue to make more loans. Who hedges? All very large firms hedge, many mid-sized firms hedge, and there are some smaller firms that hedge. There is no kind of one barrier of, well, if you're doing X amount of mortgages, you should hedge. If you're not, you shouldn't. It's a little different for everybody, and we'll get into that a little bit later about who hedges and why is that important and how do they do it. In the end, unless these loans are going into a bank or credit union or savings and loan portfolio, all of these are going to be sold into the secondary market. They're all eventually going to be turned into mortgage-backed securities. Now, those mortgage-backed securities later might be turned into other things, into CMOs or remix, and I'll stop throwing around terms like that. But the basic premise is that every single mortgage eventually is going to, if it's not going to a portfolio, it's going to go into a mortgage-backed security. So Hedging and delivering in a more advanced way of executing kind of just brings you a little bit closer to actually forming those securities yourself. If you're going to an aggregator, you're almost kind of partnering with them as they go ahead and they price loans and they form those mortgage-backed securities. So in terms of who does it, there's no hard and fast rule. There are companies that do 300 million a month that lock everything best efforts and don't hedge. There are some community banks that do 5 million a month. I mean, literally 12 or 14 loans that fully hedge all of their pipeline. So it's not necessarily just about volume. Of course, as you go higher in volume, more and more companies are more likely to hedge. Part of it's net worth. If you're an independent mortgage banker, we really like to see people at least at the Fannie Freddie requirement of a $2.5 million net worth. If you're underneath that, it's really difficult to do. And one of the biggest factors that we see in whether or not companies are hedging has to do with centralization. If each of your loan officers is kind of doing their own thing, they're sort of their own independent shop, hedging isn't really going to be right for you. And that's okay. Every company is different, the way that companies go to market and the way that they're structured. For hedging to work for your firm, you need to be very centralized. You need to have secondary capital markets group that is controlling all the pricing, controlling how loans are processed, controlling how loans are locked to be able to really get the benefit of being able to collectively either go to the securities market or find ways to manage that risk and be able to go to aggregators in the market. The next thing we're going to talk about, and so just so nobody's worried that you're going to be stuck listening to me talk for just a solid hour, I'm generally planning for this to go about 30 minutes or so, and then we'll save the last 10 or 15 minutes for Q&A and let you out a little bit early. In the end, it's kind of hard to pay attention to anybody, even if they're moving their hands around, and I'm kind of generating my best Italian that I can, even though I'm not any Italian. It's hard to do that for a full hour. So we're going to go for about a half an hour and then open this up to questions and answers. A lot of times that's the best way. If something's on your mind, chances are it's on somebody else's mind as well. So who hedges? We're going to talk about the most important thing really, which is why would a company choose to hedge? And the core premise of it is when you're selling mortgages, whether it's to a large aggregator, whether it's going directly to the agencies, what it comes down to is it's much more valuable to buy a known asset right now today than you'd be willing to pay for the chance to maybe get a mortgage in 60 days or 75 days. Interestingly, so you can sell loans to Fannie Mae and Freddie Mac, and a lot of people do. You can also securitize with Fannie Mae and Freddie Mac. I kind of wanted to ask the question in this of how many people know people and companies that sell loans to Ginnie Mae? I'm not seeing everybody's video screen, so I'm not going to look for a show of hands. But a lot of you probably would think, oh yeah, I know a lot of companies that sell loans to Ginnie Mae. You actually don't. No one sells loans to Ginnie Mae. Ginnie Mae does not actually buy mortgages. Ginnie Mae is only a guarantor. Just like Fannie Mae and Freddie Mac are also guarantors, but they additionally will buy loans through their cash window and form those mortgage-backed securities themselves. So if you're working with Ginnie Mae, you actually, by definition, you have to hedge because there's no best efforts lock with Ginnie Mae. You can originate FHA, VA, rural development mortgages and sell them to investors, but if you're going to go directly to Ginnie Mae, you're not actually selling directly to Ginnie Mae. You can only use Ginnie Mae as a securitizer. This is an important concept, and that spread between what is a loan worth to me right now that I know I can get and what might this be worth to me in 1 or 2 months can really be exaggerated during times of great uncertainty. To use an example, back in March and April of 2020, when everything was, seemed like it was swirling down the tubes and hitting the fan, so to speak, one of the heads of the trade desk of a very large aggregator, I was on the phone with them, and they said, Chris, we're in this. I know things are chaotic, but in terms of something short term, I know what I can sell a loan for at the end of this week, and I think I know what I can sell it for next week. What can I get for something at the end of the month? I don't know. What can I get something in 2 months? I have absolutely no idea. And so that's kind of a key concept in this. When things go awry, it's not the mentality isn't, well, everything went to heck and you were hedging. What happened now? It's that if you can actually have a closed loan asset right now, that has value. This can go directly into the securities market in a uniform mortgage-backed security with Fannie Mae and Freddie Mac or a Ginnie Mae mortgage-backed security. But what happens during these times of great chaos and uncertainty is that No one knows what something's going to be worth in a month or in 2 months, let alone the price they put out there that you might deliver them a loan, you might not. We have no idea. And that's why during some of those times, we actually saw some of the differences between what a company would pay you for a loan right now, or what you could go directly to Fannie Mae, Freddie Mac, or through a Ginnie Mae security for, would blow out compared to what rate sheet prices were showing. We had a number of folks that said, Chris, I need to be able to price loans, but I use best efforts pricing and I can't even get to par. So we kind of had to get pretty creative about that, because in the end, these loans were still worth something. We could kind of define what they were, but it was very hard for any company during this incredibly crazy time to step out there and take a whole bunch of locks out by putting out a decent price. So it became this race to the bottom of, everybody said, oh, geez, I widened our profit margins to 300 basis points, and we're still getting pounded with locks. In hedging, it's very important to realize, as a correspondent buyer of loans, especially, that locks are not volume. Only closed loans are volume. All that locks are actually is risk that has to be managed. And so that's why during this period of 1, 2, maybe even 3 or 4 weeks, we saw incredible chaos from correspondent buyers, because to the extent that they put a decent price out there, they might get buried with locks, and they have no idea in 30 days and 60 days what of these are going to show up, and they're on the hook for trying to hedge these mortgages. So during stable times and calm times when not much exciting is going on, that spread between what somebody might offer you for a lock for 60 days and what you can sell that asset for right now might shrink to something very small, like 25 basis points or 3/8, or a nice margin would be, say, half a point. Where you really see that blowout is during times of great chaos and uncertainty. So in terms of why the hedging, the simple reason that people like to put is, well, you make more money. And it does pay more money because you have closed loan assets. That's the reason that you do it. However, to do that safely, you have to hedge. You have to have trades out there that are going to balance out, which we're going to talk about in a little bit, that are going to balance out the risk that you're taking as a lender of offering mortgages at a certain rate and price structure, not knowing in the end what the bond market's going to look like and what the price for those mortgages will be down the road. That's the biggest reason for hedging. You make more money. Now you need to find a way to safely make more money. The other side of that, that's another side benefit of having a hedging program as opposed to locking best efforts, is that now your policies about extensions, program changes, all those kinds of things, they're your own company policies. Instead of having a case where a borrower needs 30 more days, or needs to change interest rates, or needs to change programs, or has all sorts of different things happening, instead of being at the mercy and kind of philosophically thinking, well, this is a X investor loan or a Y investor loan, or we need to find out what we need to do with it. Now it can be the policies of your company. If you run the show for ABC Bank, now it's about what ABC Bank's policies are, and not what any sort of investor policies are. So there's some nice benefits in terms of being able to manage your pipeline and help your borrowers as much as possible, given the fact that circumstances can change. They change all the time. So that's the why for hedging. In terms of the extra money that on average is made, it's not made from hedging. It's actually made from going to market in an advanced execution, like a bulk sale to an investor. It's funny, they use the term, and many of you have heard this, but some of you that aren't, that might be appraisers, processors, other avenues haven't heard this term, but when loans are being bid by an investor, it's called a bid tape. And the reason it's called a bid tape is, if you're really old like me, and back when you got started in secondary marketing, there was no email. You had Excel, but you couldn't actually do anything with it. So we would actually get a tape from our loan origination system, which wasn't on Windows. It was in the basement and in these gigantic, servers, essentially, the predecessor to servers. And you would get an actual tape, and you mailed that tape to somebody who was interested in buying your mortgages. They used a machine to read all the loan data, and they came back and they called you on the phone, or they sent you a fax and said, here's what we'll pay for these mortgages. So despite the fact that we're sharing that information in much more advanced and immediate methods than we did back then, they're actually still called bid tapes. Kind of funny. I don't know. I'm guessing when we get to, on your computer screen, the little icon to click save, in the year 3000, it's still going to be this little floppy disk that we all used in 1997, the save icon in Excel and Microsoft Word. The other big thing that we need to talk about: what, who, why. When it comes to hedging, how. Here's the big thing, right? Is a lot of times in secondary and capital markets, folks kind of have a black box around what they're doing. Sometimes they like it. If you noticed when in 2000, when in the stock market, we went from quoting stocks and fractions, which had been done for centuries. GM stock is 96 and a quarter, it's 98 and 3/8, whatever it is. They all moved to decimals. Bond market did not. Whether it's corporate bonds or treasury bonds, municipals, mortgage-backed securities, we've all stayed in fractions. In fact, we trade in 30 seconds. And people ask, Chris, why is that? Why don't you guys just trade in decimals? And the truth is that we don't want other people to know how to do our jobs. It's really a job security thing. If we don't do everything in 30 seconds, it's harder for other people. And so really it's kind of better job security for all of us in the secondary and capital markets area. That's kind of a snide answer, but it's really kind of true. The reason that actually bonds never converted is that they're not part of something that everybody in the general public is doing. It's much more of a specialized field. So anyway, if anybody ever wonders why are bonds ticks, what's a BIP? Those are just the terminology that we've ever had, and we kind of have no reason to change that so far. In terms of the how of hedging, what's really important? You've got to have good systems. You've got to have a good, solid loan origination system you can get data in and out of. Because without having good data, you can't properly hedge this pipeline. There's a term, hedging crap. You want to make sure that not just is your data good, but the people in your operations are all doing their job and making sure that if a loan's going to be denied, if a borrower truly wants to withdraw, if this locked loan isn't going anywhere, somebody needs to go into the loan origination system and enter that information in. They need to code it as withdrawn. They need to code it as denied. Having good pipeline management internally within your bank, within your mortgage company, is very important to having a successful program, because in the end, what we want to avoid is that we're hedging, for lack of a better term, crap. So how do we hedge? There's a number of different instruments that can be used, but the primary instrument that's used to hedge a pipeline of mortgages are the very things that those mortgages are all going to become, which is a mortgage-backed security. So the best way, the most efficient way that has the least amount of basis risk, for the most part, is to actually do what's called a forward sale of mortgage-backed securities. You'll hear sometimes somebody you might be talking to will use the term, we're going to buy some coverage. We're not actually buying anything. When you're a mortgage company or you're a bank, you can actually think of yourself as buying these mortgages from brokers, from your borrowers. When Mr. and Mrs. Jones lock their loan and you agree to terms, you're essentially agreeing to buy their loan from them, even though, of course, they're your customer, they're your borrower. So the way to offset that is to short or forward sale mortgage-backed securities. So today, Mr. and Mrs. Jones are offered a rate, a pricing structure. I know what the value of that is. I'm very happy with it. In order to balance out that risk, we'll want to sell an equivalent amount of mortgage-backed securities out in the future. For example, November maybe is the settlement date we would choose, knowing that on average, Mr. and Mrs. Jones will go through the process. They'll probably close their loan. They might not close, and we'll factor for that. They're going to close their mortgage. And now, come November, I can either turn that mortgage into a mortgage-backed security and deliver into that trade I made, or oftentimes what's happened is I will pair out or buy back that trade. Remember, it's a short. And instead, I will sell Mr. and Mrs. Jones's loan at current market. If back when Mr. and Mrs. Jones locked their loan, the price of this mortgage-backed security was 103. And again, when I'm putting on a hedge, I'm not covering anything. I'm not buying anything. I'm actually selling a mortgage-backed security. So I sell it at 103. If now 2 months down the road, let's say the bond market just gets creamed, interest rates go way up, the price now of this mortgage-backed security goes from 103 down to only 99, which means, of course, the value of Mr. and Mrs. Jones's loan has also dropped by 4 points. But now what I can do, I can either deliver into that existing trade I had that was at 103, or if there's something I can do with the loan that's more profitable, I can pair off or buy back that hedge. Remember, I sold it at 103. I buy it back at today's price of 99, and I make a 4-point profit, which offsets the fact that now if I'm going to sell this loan, it's going to be at 4 points less than I originally had. The opposite, of course, works when the market rallies. If the price of mortgage-backed securities goes from 103 up to 105, now I can still deliver the loan into that original price at 103, or I can pair it off, buy it back. Now this will be at a 2-point loss because I sold it at 103. I'm buying it back at 105, but now I can sell Mr. and Mrs. Jones's loan 2 points higher. So no matter whether interest rates went up, they went down, the price of mortgages went up or went down, in the end, I'm using instruments that are made up of the very mortgages that I'm hedging, and I can deliver right into them, or oftentimes what you see is I will pair off or buy back that trade and deliver into something else at the current market if it makes more money. The word pair off, for a lot of people that aren't experienced with hedging or haven't had any exposure to it, the word pair off has this negative connotation. I've talked to people before that as they're exploring this process, and the owner of this mortgage company is 65 and been in the business forever, and says, Chris, I understand what you're saying, but I can tell you what, in my time, all I know is when I hear the word pair off, that means somebody screwed something up and I got to pay money. And if you're hedging, the word pair off actually is neither good nor bad. If the market has decreased in price, your pair offs will be gains that come from dealers. If the market has increased in price and decreased in rate, then your pair off will be a loss that goes to dealers. But in the end, a pair off is just one side of a two-sided transaction, where the other side is the actual sale of that mortgage or that sale of a mortgage pool. Just because you're pairing something off doesn't mean it's because you're selling a loan to Fannie Mae or Freddie Mac for cash or to an investor. You might be somebody who's making your own Ginnie Mae security, but the market will pay you more money for a Ginnie Mae security that you can stipulate was just originated and issued today, this month. Let's say we have the price for Ginnie Mae 3 coupon securities. Let's say the price for that is 104. If you have a brand new Ginnie Mae 3 coupon security that you just made, the market will actually pay you close to a half a point higher for that. They'll pay you 104 and a half. And the reason is that the market's willing to pay 104 for any security anybody has. It might have been from 6 months ago or a year ago, or be 3 or 4 years old. But if you have a brand new security made up of mortgages that just closed, they know that that is likely to last longer because, of course, the borrowers just refinanced today than a security that they buy that might be 6 months old or a year old or 2 years old. So that's an example of, even though you have a mortgage-backed security trade and you could deliver a pool of mortgage-backed securities against it, it gives you the flexibility to, if you can actually create something that has more value right now in the market, you can use that short of a mortgage-backed security as a hedge, pair it off, and deliver something that has a higher, pays a higher premium in the market while still having kept yourself protected. There are some other things that can be done. Again, I'm trying to keep this to hedging 101 and not get into 201, 301, or especially into 401. But there are other hedging instruments that can be used as well, depending on how you're going to market. There are some companies that use options as part of their hedging strategy, especially if they're a company that sometimes you'll see cases. There was a very large originator who years ago would put all sorts of advertisements on TV of, hey, we'll lock your loan, but if interest rates go down, you get the lower rate. And sometimes that worked and sometimes that didn't. But how does a company do that? Well, they can do that by actually using options that give them, just like they're giving the borrower, the option, but not the requirement to deliver at a certain price. There's no free lunch. Those things all cost money. So sometimes we'll talk to folks that are loan officers, branch managers, or presidents of banks and mortgage companies that say, hey, we're getting killed by this across the street. How can we compete with that? And the answer is they can. But when they take a look oftentimes at how much that costs to buy those options, you have to remember, whether the interest rates go down or not, you actually have to pay that premium up front. When they take a look at the cost of that, and now what interest rates they'd have to offer to cover that cost, oftentimes they realize, you know what, maybe we'll kind of just keep doing the way things the way that we have been, and having it be a lock is a lock. So like I said, there's a lot of different things that you can do in hedging a pipeline, but the dominant thing, and especially the most important thing we'll continue and talk about for this conversation, is a forward sale of a mortgage-backed security. Just like being short 100 shares of Ford stock is the opposite of owning 100 shares of Ford stock. When we're actually hedging with mortgage-backed securities, they're all forward sales. They're all shorts of mortgage-backed securities, so that we're offsetting the fact that when prices go up, this value of this hedge goes down, and when prices go down, the value of that hedge goes up. They're going to move in equal and opposite directions. So those are kind of the four core things when we talk about this of what, who, why, and how. So I know Lindsay's had the chat open, and because I have trouble multitasking, I have not been looking at it. So Lindsay, if you've got some questions that have come up there that I can kind of address or expound upon a little bit more, if anybody wants me to talk about a certain aspect of it, please, I'll take a little sip of coffee here and And I'm all yours. I'd love to continue in whatever direction that the group would like to continue.
Sure. One question we have come in is, in terms of capital requirements, where does a mortgage lender need to be in order for hedging to be a viable strategy for them?
Yep. It can depend on if you're already servicing loans, because of course, if you're servicing loans, that also eats into the amount of capital you have. But really, any depository has plenty of money, of course, to do that. And even for an independent mortgage banker, what we really like to see is to be at the Fannie Freddie limit of $2.5 million in net worth. That doesn't mean that you don't have to have approval from Fannie Mae or Freddie Mac to make hedging make sense, but there are a lot of things that need to be done for that program to be successful. One is that you need to be approved by, if you're going to sell to investors, you need to be approved to sell to those investors on a mandatory basis. The investor is taking risk that you say, hey, I'm going to sell you these loans, and then you don't deliver them. They're going to come after you to have a pair off, and this isn't the good time, this is the bad kind of pair off. So they've got to make sure that you know what you're doing. They want to see that you've got lots of experience in house. Are you using a hedge advisor? Do you have your policies and procedures set up? Because they're taking risks of buying loans from you on a mandatory basis. In addition, part of to be able to hedge, you need to have accounts set up with broker dealers. And they will have minimum net worth requirements that generally vary anywhere from 2.5 million to some of them, they want $50 million in net worth. But oftentimes 5 and 10 million is the net worth requirement that a lot of dealers have. So you've got to have the net worth to be able to get those approvals. The other is that hedging involves some cash flow differences. Let's say you have a case where the market's tanked substantially. Prices have gone from 103 down to 99. And now everything's been hedged and everything's great. You're in good shape from an overall gain loss perspective. However, you're now selling mortgages right now today at prices of 99 and quote unquote coming in 400 basis points lower than you thought you would get. Now that's going to be made up for by the fact that all your dealers are going to wire you 400 basis points in pair off gains on all your hedges, but that doesn't come for 2 or 3 weeks. So having a difference of 2 or 3 weeks in the amount of cash that you're receiving less than expected and having that made up by the broker dealer is something that it needs to be okay. So really, we like to see not just a $2.5 million higher net worth if you're an independent mortgage banker, but we want to make sure that you've got enough cash that if you get a margin call, for example, if you'll say your positions go underwater a certain amount because the market has rallied quite a bit, the dealer will make margin calls on you. And you can make margin calls on the dealer if the other way happens. If prices decline substantially, your hedges with these dealers are in the money by $500,000, $1 million. You can call margin on those dealers if your agreement allows that. But all these things involve some movements of cash. In the end, your GL was protected properly. Everything worked out in the end, but you might have a case where you need to outlay money in pair off losses now, and it's made up for by selling loans at 106 in 2 weeks, or vice versa. So that's another reason that we want the minimum net worth requirement that at least we like to see to make sure that people can have a successful hedging program. Great question.
Yeah, and along those same lines, what sort of infrastructure does a lender need to have from a personnel perspective in order to effectively run a hedging strategy?
Sure. We see all sorts of different structures out there. There are some that have a very traditional head of capital markets. They've got a very robust lock desk. They've got folks that maybe they're doing all their own trading. Maybe they're outsourcing all or some of that. It really kind of runs the gamut. But when you take a look at, people will often ask, they'll say, well, we do things on a best efforts flow basis. How would it change if we're doing that? And really from an operations perspective, there's not a heck of a lot that changes. In the end, if you're selling loans to investors, whether it's on a best efforts flow basis or whether you're hedging them and selling them after they close, you're still delivering loan by loan. If you've been going to market with Fannie Mae and Freddie Mac and locking loans best efforts, and you convert to a hedging platform, you're still, again, delivering those loans on largely a loan-by-loan basis. With Ginnie Mae, you're really only able to securitize with Ginnie Mae if you're already hedging in the first place, so that part isn't really much of a transition, at least not at first. So a lot of the core aspects of how you actually do things operationally, they're really not very different. It's kind of funny, we joke with people, they've gone for weeks and months getting prepared. There's little things you might have to do of making sure that because you don't know where a loan is going when it closes, there's no goodbye letter that goes in the closing package. What you need to do is say, all right, Mr. and Mrs. Jones, we, ABC Bank, are your lender, and you'll make your payment to ABC Bank. And then later on, if that loan is sold to somebody and ABC Bank is not the servicer, then they'll get a goodbye letter, they'll get a hello letter from the new servicer that probably won't even have made that payment. But those are just little subtle differences. But again, when you take a look at operationally, how different is it? We tell the people kind of, if you initiate a hedging program on day one, it's actually not really very exciting. All you do on day one is just don't lock your loans, best efforts that day. So the operational hurdles they're important to take a look at and know what kind of pitfalls there are and make sure you're prepared. It's definitely more important that something is done right than that it's done quickly. But a lot of times people kind of in the end, they find out, well, gosh, that was a lot easier than I thought it would be.
And for lenders that have that implement a hedging strategy, are they locked in to that strategy permanently, or is there opportunities to move between best efforts and mandatory?
I guess you could. And sometimes it can depend. I guess we've never seen a case where someone started a hedging program and then stopped it. You really have to have your company would have to be going through something really tough. Like you went from 50 million a month in volume to 3 million a month in volume, in which case you've got a lot bigger problems than that. But there are things, there's not every single thing shouldn't necessarily be hedged. One of the things that it can kind of come down to really a risk reward. If you're looking at true jumbo or non-QM, oftentimes we see people prefer to, and we think it's generally a good call, to continue to do those loans on a flow basis. If you have a loan program, let's say you want to do 203K loans, and you're not a Ginnie Mae issuer. In that case, you're probably better off finding an investor for that 203K loan because it's such a specialized program, and going ahead and locking that up and putting it to bed. If you have a loan program that isn't very vanilla, if it's kind of, we only have one investor that buys FHA loans with a 580 credit score, you're really better off locking that up and putting that loan to bed. To the extent that you have vanilla mortgages that everyone's interested in buying, you can go directly to Fannie, Freddie, and Ginnie with them. Those are loans that we typically see that are always going to be hedged. And there can be some different times where, let's say you're someone who sells only to investors, or even actually in this particular case, you had a Fannie Freddie relationship, and suddenly in March of this year, in April of this year, a lot of the rules changed about second homes and investment properties. We saw a number of folks that we work with go back, and for a period of time, because it was so chaotic, any investment property and second homes they went ahead and they priced it and locked it on a flow basis because there were things happening in the market that weren't normal. They couldn't manage that risk based on just the movement of interest rates, the movement of mortgage-backed securities. So the nice thing about having a good hedging program is you can make those changes on the fly as a company. If something changes and you're having an issue with an investor, you're not locked into everything that you've already committed to them over a 60-day period. You can go ahead and change channel. You can kind of shift what you're doing. It's nice to be able to have we see a lot of folks that we work with that they like having direct agency relationships, but they also like having the opportunities to sell to investors if there's some characteristics of those loans that an investor much prefers over them. Kind of one of those things of we like to keep the servicing, but if somebody wants to make it worth my while, sure, we're glad to sell mortgages to them. So there's a lot of different things you can do, and you can make those decisions very quickly if those loans are being hedged, as opposed to kind of having your hands tied for a 30, 45, 60-day period before you can actually make strategic changes. I hope I did a good job so far in presenting this. I try to avoid the use of any Greek letters and as few acronyms as possible. So there might be some folks where they were all things that they knew, and that's okay. Like I said, we do 301, 401, and other stuff as well. But kind of really my main goal with this is to take folks that have no experience at all in hedging or in secondary marketing at all. We've got a lot of folks that are in this call that work for MI companies or are in the appraisal side of things, underwriting, processing. If I was going to attend a seminar on underwriting, I don't even know enough to be dangerous. So I like things presented at kind of a base level to kind of help me understand how that fits into everything else that we do as mortgage bankers.
Great. I think we have one last question.
Yeah, great.
It is, for lenders that maybe aren't quite ready to move to hedging, what are some things that they can do today to help prepare them and get them on the path to making this a part of their future strategy?
That's a very good question. I think one of the best things to do is talk. Really, I think, it's great to talk to someone who's a hedge advisor. But one of the better things even to do is to talk to your peers in the industry, whether it's part of a co-op that you're part of, or just there's so many folks that have made friends in the business, that they have maybe similar companies. Sometimes they're direct competitors, sometimes they're not. But go ahead and just throw it out there. Ask other people, what are they doing? What's worked for you? Have you heard of this? What are some of the pitfalls? What do you think should be for us? Don't be afraid to, put yourself out there. There's a lot of companies, and whether it's hedging or appraisal management or mortgage insurance or all the different great vendor relationships that are out there, all sorts of different aspects of the business. In my opinion, the best thing that you can do as a bank, a mortgage company, a credit union is talk to your peers. Talk to people about what they're doing, what's working for them, gather that information, and then make your strategic plan from there.
Fantastic. Thank you. I think that was all the questions we had.
All right. Well, great.
I'm going to bring
thank you,
Michelle back.
Yeah, well, thank you very much for running the show, Lindsay. I appreciate it a great deal, and thank you everybody for carving out part of your day. Like I said, if anybody wants me to get into 201, 301, and 401 in later sessions, just let me know. I'd be very glad to do that. It's I've been fortunate to be part of this industry for about 30 years now, and so one of the things that I really like doing is I've had so many mentors along the way that have taught me all sorts of parts of the business I'd never had exposure to. So one of the things I really like doing is working with all sorts of great people and all sorts of different channels of the business, and trying to help share some of the information and knowledge that I have with them. So thanks everybody for letting me be part of your day, and enjoy.
Thanks. We really appreciate it, Chris, and we appreciate your participation as an annual sponsor of the MBA of Florida. So again, we're just pleased to be able to bring such quality content to our members and non-members alike. But again, we hope everybody will become a member. So with that, thank you all, and we will all talk soon. Thanks.
Thanks, Michelle.